a lot of knowledge brokers, a lot of agents out there that want to try to understand this don't quite get it. And consumers are struggling with this too. And I know, Lisa, I'm sure your agents get this. I know mine do. At Byron, same with you on our respective teams. Hey, we're going to wait for rates to come back down because they see what the 10-year's doing. How do you explain that to consumers in a way that's easy to understand? Because even what we're talking about here requires some knowledge of the market. And we know consumers move every 11, 12 years. Only about 5% of the population's even thinking about making a real estate decision at any given time. So the knowledge broker can take that info and make it simple to understand. How do you recommend doing that for folks?
Tom, that's a very, to me, timely question and also very important. And my view on the spread, so without getting particularly theoretical or esoterical, the spread between the two, it really is a measure, think of it as a measure of risk in some ways, right? The market is trying to account for the risk, both short term, what's happening in financial markets right now in the economy, housing, job market, but also longer term, right? So we have 30-year mortgages, but generally the reason they tend to track the 10-year Treasury more often than not is because in light of the fact that most consumers tend to stay in their homes for about 10 years, right? That's the period at which you as a financial market investor are going to consider the risk of your mortgage-backed security. So in a sense, what this tells me is currently a lot of the bond market views the risks in the economy and housing being much, much higher on the downside, which is why you're seeing that spread wider. And so to your point, absolutely, viewed in the light of the long-term trajectory, rates should be lower. But at the same time, let's acknowledge the fact that we're coming out of a highly unusual period, right? A pandemic is not something that happens every 5 years or even every 10 years like most recessions tend to. In addition, this pandemic was not only unprecedented in the sense that it was by its nature so widespread, global, but here's the key from my perspective. The government's response was unprecedented. We've had the 1918 flu pandemic. We've had other viral pandemics even in the 50s in the US. And of course, going back centuries, never has a government, to my knowledge, shut down the economy and told everybody we're going to put the economy partly on pause because of it. Now, I don't necessarily question that decision because the health of all of us, our families, our friends, were obviously on the line. And for a lot of people, there are questions. But let's understand that there's not a zero cost to that, right? And so coming out of this highly unusual period, it's not surprising that we're trying to get our bearings. Where are we? Where's the economy going? What's happening to the markets? And that's before you even throw in the Fed, the supply chain, all the other things. And I say that because I want to remind a lot of people that the uncertainty, the volatility we're experiencing today is not that unusual given the period we've traversed. So back to your question, how do you talk to people about where mortgage rates are? And specifically in terms of the outlook, number one, looking at the 10-year Treasury, I think is a good indicator now that a lot of brokers are keenly aware of what's happening sometimes on a daily basis. Number two, understand that where we're seeing mortgage rates right now have been driven there by a combination of factors. Number one, inflation, right? Because all lenders had higher costs. They had to pass those costs through their product. Their product is a loan. Two, the Fed increasing borrowing rates, right? The Fed rate is a basis for a lot of things like the prime rate, adjustable rate mortgages, car loans, personal loans, and so on. So that rate going up also pushes things up. My view, when I look at inflation, at least measured by the CPI, the Fed looks at the personal consumption expenditure, the PCE price index. But you go back and you look all the way to the 70s, what you see is mortgage rates tend to, with a lag, follow on the way up inflation, and then again with a lag tend to generally follow inflation on the way down. And I look back specifically in 1970, late 70s and then early 80s. This is where the Fed right now is fully fixated on. Why? Because they learned during that period when inflation shot up, the Fed initially hiked rates, then put them on pause, only to then watch as, this was late 70s, only to then watch the 1980s inflation shoot up double digits, 14, 15%. And then Paul Volcker came as chairman and decided we're going to kill this thing and in the process kill the economy. So the Fed is saying we're trying to take that lesson and make sure that it's a one and done monetary tightening right now so we don't have that spike. So my view is if the Fed is successful in accomplishing its task and subduing inflation back near 2%, we can expect to see mortgage rates begin to trend down in tandem with a slight lag.